Hello, everyone. I'm Elizabeth Kerr with Business Forward. Thank you for joining our conference call with Mark Domes, the Undersecretary of Economic Affairs at the Department of Commerce, and Beth Ann Bovino, the U.S. Chief Economist at Standard & Poor's. Today, they will discuss the fourth quarter GDP estimate just released this morning. After their briefing, there will be time for questions. You can ask a question two ways. At any time during the call, press 1 and you will be entered into the queue to speak live, or you can email your question to info@businessfwd.org. Before we get started, some quick background on Business Forward. We are a national business organization that helps business leaders from across America brief Washington on how to create jobs and accelerate the economy. Over the past 6 years, we've helped tens of thousands of business leaders brief more than 450 senior administration officials, members of Congress, governors, and mayors. A few important notes about the call before we get started. This call is open press and there are reporters on the line. Also, you should have received an email with a link to the presentation associated with the call. If you don't have it, please email info@businessfwd.org and we will resend it. As a reminder, after Beth Ann and Mark have concluded their remarks, there will be time for questions. You can press 1 to speak live, or you can email us at info@businessfwd.org, and we'll read your comment or question aloud. And with that, I'm going to hand it over to Mark Domes, Undersecretary for the U.S. Department of Commerce.
Thank you, Liz, and thank you all for joining. I'm looking forward to this and looking forward to your questions. It's great to be here. It's great to be here with Beth Ann Bovino, just a great forecaster and an economist. So I'd like to take a couple minutes to talk about the economy, especially in 2014, and how it performed at the end of 2014. And Beth Ann is going to provide more of an outlook picture. So if you turn to the presentation then, if we go to the at 8:30, our GDP estimates that rounded out for 2014. And what you see is that for the year as a whole for 2014, the economy grew 2.4%, a bit higher than the previous 3 years. And what this chart doesn't show is that in the second half of the year, the economy actually picked up quite a bit of steam. If you smooth through the last 2 quarters, growth averaged 3.8%. And so if you look at the quarterly data as well, 2014 was really held down by a negative number we had in the first quarter of the year. And when you look at the industry level detail, which we only have through Q3, what you see is that the recovery we had in 2014 was very broad-based. We had gains across most major industries. If you turn to the second slide then, please, labeled consumer spending, what we see here is something very similar to the total GDP picture, which isn't surprising given the role of consumer spending in GDP. We had very high growth of 2.5%. And again, in the second half of the year, if you look at Q3 and Q4, we had PCE growth, consumer spending growth, that averaged about 3.8%, just a pretty high rate. And also, that's consistent with that we had an acceleration in job growth in the second half of the year. Incomes went up last year. Again, we had acceleration in the second half of the year. And then if you look at other measures of the consumer, if you look at consumer sentiment from a couple surveys, those surveys have recently ticked up quite a bit. So it seems like consumers are getting more optimistic. And one thing that a lot of economists look at in terms of consumer optimism is kind of car and truck sales. When people are feeling more optimistic, they're more likely to pull the trigger for these big durable purchases. And indeed, in 2014, we reached the highest level of new car and truck sales since we had since 2006. Turning to the next slide, investment. We posted growth last year. We have growth in most areas, and this is an area where we see growth in single-digit areas, in single-digit amounts in lots of different areas. And even in Q4, we still saw an increase in investment in, say, in oil and gas drilling. I'm sure there'll be questions about that. We didn't see the data in that area tail off until December, but the first couple months of the quarter, things were still pretty rosy. Next slide, I think, is a really important picture, which is kind of government expenditures. What role does government play in GDP growth? And I think a lot of people don't really realize that the magnitude to which government spending has been a drag on overall economic growth the past couple years. So you see this chart, real government spending, fell 2% in 2013, 3% in 2011. And last year, it was almost zero. And that reflects a slight drag at the federal level, but we've actually seen an increase at the state and local level. And one remarkable thing about this recovery relative to other recoveries, especially at the state and local level, is that state and local level employment really took a huge hit in this recession. It's been somewhat slow to recover, but now that picture is becoming more positive, and also the federal government, the drag, especially say from the sequester in 2013, that's beginning to dissipate. So the government isn't as being much of a drag on the economy going forward. And then let me just finish with the last slide labeled exports. And here the basic story is that even despite in kind of a turbulent year overseas, and despite a year that ended with a large appreciation of the dollar, our exports are still increasing. They increased in Q4, and they increased, over the year. And as I'm sure Beth Ann will talk about, and we'll get questions about, if we look around the world, we see a deceleration in growth in lots of areas, and that has really kind of first-order effects on our export growth. So the fact that we do have this kind of slowing growth around the world and our exports are still increasing, I think really speaks to the kind of the resiliency and the productivity and the innovativeness, especially of our manufacturers. So with that, I'll pass it back to Liz and to Beth Ann.
Thank you, Mark. Now we will hear from Beth Ann Bovino. As a reminder, she's the chief economist at S&P, and she'll give us a perspective from the private sector. Beth Ann, go ahead.
Got to have spent a few minutes before the talk, so I got to pick his brains about the BEA report. So that was a nice little bonus, because I always look at their data anyway. So it was a nice little bonus. So let me see if I can shed a little bit to the audience what we're seeing in these numbers and what this means for our forecast going into next year. Into next year and following. So if we go to the first slide, this is really looking at sort of where we are in terms of momentum in the U.S. As Mark had mentioned, you can see pretty much throughout most of this recovery, we've been pretty much below par in terms of growth potential. 2.3% has been the average throughout most of this recovery. Not surprising, because we went through one of the worst financial crises since World War II, which usually means a drag on growth, largely because people are cleaning up their balance sheets. But we've seen an improvement since then. If you look at what's happening in terms of 2013, as Mark had alluded to, you can see the second and third quarter growth readings. I believe that might not even capture the new actually it does, strong readings. We saw 4% plus, I believe 4.6 for the second quarter, and 5% for the third quarter. So we did expect to see some pullback. Not as much as what we did see. Standard & Poor's was looking at about 2.8% growth for the fourth quarter, came in at about 2.6, so it was a little bit weaker, but really not that fall off. However, markets were expecting a bit more, so you could expect to see the stock market react to these numbers a little bit more severely. Markets were looking, at least from our estimates, they were looking for around 3.3%. So indeed, that would probably cause a little bit of an impact to markets. However, overall, it seems like the underlying numbers still looked rather positive. Consumer spending was incredibly strong, over, I think it was 4.3%, the fastest pace in 9 years. We're wondering if households are taking advantage of that savings at the gas pump and spending it at the mall. That could be one factor that's at play. We did see trade slow down a bit. Possibly we saw that in the fourth quarter, maybe because the dollar strength is starting to have some impact, but we don't really see it that much in terms of sentiment readings from manufacturers. They're already still seeing some strength there. Finally, a couple other points that I wanted to make is that with trade, we're going to have an estimate. That's still an estimate. December is still not out yet, so we'll see how that trade component of GDP really does impact the overall growth rate for the first quarter. Now, that overall 2014, 2.4% was pretty much in line with what we were expecting. So again, this really kind of just confirms how we see the U.S. economy. Inventory, if you want to know what we're expecting to see for, or at least what markets are going to see going into the first quarter, that strong inventory accumulation for the fourth quarter, I think it contributed over 80 basis points to the GDP growth rate for the fourth quarter. We could expect that this might, for some in markets, that might have been a lot stronger than what they had initially forecasted. So you could expect to see, because if businesses are and have their shelves full, they might actually not need as much in the first quarter. So you might see markets pulling back on first quarter estimates. Not likely to impact our first quarter estimates that we have at about at about a little under 3%, but you could see some ramifications there. Inflation is still soft. The Fed still says it's transitory. We'll see how they take these numbers in their analysis and their policy measures. If you go to the second slide, which is looking at employment. There you're looking at, sort of fits what the Fed is saying, that jobs numbers have been coming in very strong. You can see that in this chart, the blue line is non-farm employment. You can see it climbing higher and higher. Indeed, in 2014, we had monthly job gains at about 246,000 a month. That's a pretty nice reading. We think at S&P, we think that's going to hold up around there, maybe a little lower, but still above 200,000 per month this year. So that suggests, according to that chart that you're looking at, that we could expect to see in the red line non-residential construction picking up as well this year. Why? Because if businesses are hiring, they're probably going to need some office space to put them in. Now, wages are another story. Wages year over year, wage gains have been flat throughout most of this recovery. However, we are expecting to see some improvement in terms of wage gains as we go into the year. It's been a buyer's market. Employers have been able to get pick and choose. However, some signs that we look at to check and see what's happening there. Kind of looking underneath the hood, we're seeing the unemployment rate come down pretty nicely at 5.6%. But what we think is more of a driver in terms of the job market wage gains is looking at short-term unemployment. That's now at a 7-year low, suggesting there's more bargaining power out there. And indeed, the quit rate, or that voluntary separation from the job, is now it had hit a 6-year high. It's come down a little bit, but still rather high. Still rather high, suggesting wage gains further on. The next chart you want to look at is where we also see with housing. Housing indeed has been sort of the Fed's sort of the patient that they want to see live. Now here we're looking at housing. Of course, here in this red line you see home prices taking a dive on a year-over-year basis. We've seen those that we believe, according to the S&P Case-Shiller, they've stabilized and have been climbing higher ever since. Not quite near the pre-crisis highs, but indeed slowing an upward path. Housing starts have bottomed out. They hit a World War II record low during the recession, but now they're at around 1 million, or been holding above 1 million now for some time, and that's actually a good sign. Indeed, new home sales and existing home sales are showing some strength, continued strength, which we think will continue, particularly because we have jobs coming back. Jobs seems to be coming back. That means people have paychecks to be able to buy a new home. And in addition to this, with the strong stock market and also with home prices climbing higher as we expect this year, that does also suggest some strength for the housing market as we go through. There will be some signs that it will be a little bit slower. One factor is higher interest rates we expect this year. We do think the Fed is going to raise rates in June of this year. We've been holding to that forecast pretty much since for about several months. Indeed, second quarter 2015 rate hike we had expected since March of last year, and we fine-tuned it to June, and we're still holding to that. Indeed, we also think the sticker shock from higher prices might slow down demand, but we don't necessarily see this would derail the recovery in housing. We think it's going to pick up. All giving, with a strong jobs, strong housing recovery, all giving reason, and also with higher wages, all giving reason for the Fed to move. We think that the low inflation levels that we are seeing, which the Fed had pointed to in their statement, we think that we agree with the Fed that we believe that is transitory, and we do think that inflation and wages will be picking up slowly, giving the Fed reason to move. The last chart, and I'll finish up here, is with manufacturing. Manufacturing has been sort of one of basically the darling of this recovery for most of the time period. And when that chart does come up, what you're going to see there is that business equipment spending also hit, and one of the drivers of manufacturing strength was hit very hard during this recession, like everybody else, with double-digit declines during 2009 and early into 2010. We saw a real nice rebound in business equipment spending in 2010, all the way throughout most of this recovery. And that indeed helped with manufacturing sentiment. We've seen business equipment spending holding up relatively well, on and off at different times, as Mark had alluded to, but it has been relatively strong, explaining why manufacturing sentiment readings have been above 50 indicating growth for 19 consecutive months. We think that strong economic expansion, which we think is likely through this year, we're looking for about 3.3% growth for GDP in 2015 or thereabouts, at least over 3%. We think that's likely going to continue to support continuing manufacturing this year. Transportation costs, indeed they've dropped a bit, but indeed that buy local mentality seems to be holding in the U.S. and the rule of law is also helping there. Indeed, protecting our patents would be needed to maybe make it here. Also, the cheap natural gas is another reason why we think that moves the needle closer to home in terms of building here, manufacturing here rather than abroad. The dollar strength will likely weigh on the competitiveness of manufacturing exports. The sentiment readings don't show it yet, and indeed Mark had suggested that it's not really showing up yet in some of the real data. But indeed, that could weigh on it down the road, but we don't think it's going to shut down or derail manufacturing, just maybe slow it down a bit. I think I'll stop here and pass it on to Liz to see if there's any questions.
Great. Thank you both for those presentations. They were really informative. I'm sorry to anybody on the call who couldn't see that last slide. We are working to get that up in front of you, and you do also have it in your email in the PDF that we sent around. Our first question comes from Johnny Johnson. Johnny, you should be live on the call. Go ahead and ask your question.
Hello?
Hi, we can hear you. Go ahead.
I'm sorry. I made a mistake and pressed the wrong button. Thank you.
I'll answer that question.
Oh, yeah, sorry, but hopefully we'll be able to get back to Johnny there in a moment. We had a question emailed in. To what degree do the trade machinations coming from China via the apex influence the U.S. economy? That's from Michelle Krause.
Beth Ann, you want to take that one first?
Well, I'm trying to get Could you ask that question again, Liz?
Yeah, sure. To what degree do the trade machinations coming from China via apex influence the U.S. economy?
Well, I think what we're seeing now, what we're seeing right now is we've been seeing that U.S. exports, and particularly through manufacturing, which is actually a kind of a factor that plays into the China question in terms of trade, is that U.S. manufacturing has been incredibly strong for the last 3 years, and that indeed has actually made us more competitive relative to China in terms of our trade activity or exports abroad. It's actually made us more competitive. Our labor costs are relatively low relative to China, particularly because of productivity is so strong in the U.S., giving us a little bit of an edge on China overall. Indeed, you're seeing trade slowdown with China as or at least China's trade to the U.S. has actually slowed a little bit over the most recent quarters, suggesting that U.S. manufacturing or U.S. products here is being much more successful in terms of business here rather than abroad.
So, Michelle, this is Mark speaking. I spend a lot of my time talking to companies all across this country. And one common theme that you hear is that the great rush to offshore production to China in the early 2000s and the mid-2000s was maybe a bit hasty. And when people actually look at the total cost of doing business overseas versus here, especially China, a lot of companies are beginning to realize maybe that value proposition wasn't as rosy as what people had thought. The story you hear is that people were just looking at just labor costs. They didn't look at the cost of holding inventories. They didn't look at the cost of the fact that it takes a long time to get products shipped across the ocean. People didn't look perhaps as closely as they should have on intellectual property protections. And so as a consequence, we have more and more companies who are beginning to move their production back to the United States. And I think that's a story that you're just hearing more and more.
Great, thank you both. We have another international question here. This one's from Laura Dawson, and her question is, there's a lot of fear regarding the new TPP agreement. How do you project this trade agreement to affect employment, GDP, and the services to reflect the agreement?
Do you want me to touch on this a little bit? Or?
How about if I just make a statement or two about it?
You go first, yeah.
So the people who've looked at this issue, usually when you pass trade agreements, the effect on the economy is positive. You're making the economies operate better. And in particular, what TPP will do is ensure kind of common standards across countries, so that if the United States has certain standards, those standards would be on those other countries, and really open up export markets for the United States. The real idea behind this is you're trying to make a level playing field, so everyone's playing by the same rules, which really isn't the case now. And fundamentally, when I think about this as an economist or just as an American citizen, that's the way I think about it.
Yeah, I'm not sure if I have much more to add on that. Obviously, some of the issues that need to be addressed is in terms of environmental concerns and how this plays in terms of trade agreements. I know this is something that's been discussed for TTIP at least. But overall, I see this as actually a positive. It kind of grows. The pie gets bigger, so that I see that as more of a success rather than a some get we get some and they get more or et cetera. It seems like just the pie gets bigger, so more for all.
Great, thank you guys. Our next question comes from Marcus Kalui, I believe is his last name. His question is, given that consumer durable spending has caught up to the pre-recession trajectory, would you expect durables growth to slow somewhat going forward and consumer spending shifting toward more services? And I can repeat that if you'd like.
Well, in our forecast, consumer durable spending, a lot of that is tied to cars. That would be one factor. Of course, you also are going to have furniture or other things that would go into appliances, et cetera, that would be playing in that in terms of durable spending. We would expect to see some slowdown in terms of car spending. Why? Because we had such a strong year this year, but we don't think it's going to just trail off or drop. We just think the pace might slow a little bit according to our forecast at Standard & Poor's. However, another factor that we see in terms of 2015 is that we do expect to see housing pick up. We're looking for a nice reading in terms of housing or residential construction, and also in terms of existing home sales through 2015. And when you do see more sales, you often see more furniture and appliances being built. So that might be something that will keep that durable orders figure, or durable spending at the consumer level still rather robust.
So I could just add on to what Beth Ann said, and I agree wholeheartedly. The biggest driver of consumer spending is income. So if we're asking the question what's going to happen to income next year, most people in the private sector, including Beth Ann, are expecting good job gains and then also accelerating wage gains. So those are going to be really big drivers of income. So if consumers have more income, they're likely to spend it. Maybe the split between durables and non-durables will shift a little bit. But something else that we're looking at, which is fascinating, which is what Beth Ann was talking about in terms of households, is what's going to happen to the household formation rate. We know the household formation rate was depressed during the recession. The stereotype is you have somebody living in mom's basement as opposed to getting their own apartment. So as the household formation rate increases, the demand for new houses is going to increase, the demand for new apartments is going to increase, and as a consequence, then people buy lots of durable goods, which is the exact same point that Beth Ann was making. In terms of cars, what was really striking during the recession and the subsequent recovery is if you look at the average age of cars on the road, those hit all-time record highs. So it's a fascinating question. So, in terms of the replacement cycle, will we still have lots of people replacing their older cars with newer, more efficient cars?
Yeah, to back up what Mark said, we, at S&P, I think I talked about it earlier, we are expecting wages to climb higher this year. Give people a bigger paycheck, that means they'll be able to spend a bit more at the mall. And of course, we're also expecting oil prices to stay. We do expect a little bit of a pickup, but not much. That means that there's still more money in their pocketbooks that's not spent at the pump.
Great, thank you guys. Our next question comes from Terry Williams. Terry, you should be live on the air, on the line.
Yes, I'm here. Can you hear me?
Go ahead and ask your question. Yes, we can.
Okay, I had emailed it as well, but my question had to do with the government expenditures. How has businesses who depend on government contracting been affected by the decrease in government spending?
So that is a channel through which government spending does affect the economy, and given the fact that the government does spend several $trillions, it does have a significant effect. And I don't have kind of specific numbers on number of businesses that rely on government contracts. I know the number is large. But when government spending is contracted, let's say through like the sequester, for instance, that does have ripple effects through directly the private sector.
Right. I mean, I'll just speak. I don't have any. Again, I don't have any concrete numbers in terms of the impact on businesses. But as Mark had suggested, what you're going to see is that if the shutdown, for example, the impact on for example, the impact on businesses was, well, there was going to be no production activity. So what they did was, and not often did they actually let go of workers, but they might have actually put them on furlough as well, just as government employees were put on furlough. They put them on furlough and they just sort of wait and see. But that economic activity or lost economic activity means no growth for those sectors. That means no contribution to growth for GDP. And that means a slow economy. I believe the figures in terms of, I guess Mark put the figures in terms of the slowdown for 2013 in terms of real government growth. It was a year-over-year percentage drop in 2013 was 2%, negative 2% in terms of real government growth. Well, what does that mean in terms of the knockdown effect in terms of that means less spending. That means less revenues for businesses. That means businesses don't need to hire as much. So you could expect to see that trickle through.
Great, thank you. Our next question comes from David in New York, and his question was, will the Fed's historically high balance sheet limit its willingness and ability to raise rates in the near future?
Do you want me to take that?
I can't comment on the Fed.
Oh, well, then I guess I will do it. I will take it by default then. So where we see certainly the Federal Reserve. What I had earlier mentioned is that we do expect. I thought the Fed statement 2 days ago was pretty confident about the strength of the U.S. economy. In fact, they said economic activity since December, since their last meeting at December, was solid. All I could think about was that song "Solid Like a Rock," "Solid as a Rock." I won't sing it, but anyway, what I thought was, okay, they seem to show that the momentum in the U.S. economy seems to picking up. Obviously, there's going to be hiccups along the way, but they're pretty confident that the momentum is there. I think that that suggests to me that they're going to move ahead in terms of their first rate hike. We are expecting it in June of this year. We've been holding on to that forecast for some time now, and it seems like this confirms our expectations. Now, slow inflation is something that kind of might keep them at a very slow pace, or as they say, continue to be patient. Now, as you mentioned in terms of the large balance sheet, yes, the balance sheet is incredibly large. I believe it's I guess when I last checked, it was about $4.5 trillion. What they have told us at times is that they plan to just allow it to roll off. Let the assets that they're holding reach maturity, and then just roll off their balance sheets. If they did this gives them. It basically takes a long time to bring their balance sheet back to rather what would be kind of normal Fed balance sheet. It probably would take them about 10 years, and that doesn't give them a lot of wiggle room. But your question then is, of course, is that does this mean that they can? How will this disturb or affect their move to raise interest rates? I think they have other options that they can take into place. Some of them could be, for example, increase. They would need to neutralize this balance sheet, or at least so that it doesn't impact the rate hike efforts. To avoid banks from circumventing their monetary policy on interest rates. Something they could do is raise interest on excess reserves. That would keep maybe the banks actually keeping the money back in there rather than going out and kind of circumventing their activities on the on their federal funds market. They could also maybe use the reverse repo market they've talked to. Maybe also increase the age of term deposits. Something that I'm sure they are discussing as they speak. They have a lot of economists that have been working on this day to day, night and night for probably several years, and I expect they will have answers to this. So I'm pretty confident that they'll be able to move the first rate hike in June, and while I'm sure there's going to be some wrinkles along the way, I expect they'll be successful in the end.
Great, thank you. Our next question comes from a Wall Street Journal reporter, and his question, this is Jeffrey Sparshot, and his question was, while the unemployment rate has been coming down, the participation rate is also near a long-term low. Do you think this is one factor holding back wages? And also, when and where do you expect to see faster wage growth?
Sure.
I think first and I'll follow up.
Sure, I can take that. So the question is that while the unemployment rate is coming down, the participation rate is at an all-time low. I believe it's now at 37-year all-time low. I believe that's the figure now.
Near all-time low was the question.
I think it's I think it's at a 37-year all-time low. And then I think the question is, I believe was, how does this impact wages? Is that?
Yeah, the question is, do you think this is one factor holding back wages, and also when and where do you expect to see faster wage growth?
Right. I think that in terms of the impact on how this affects wages, I would say probably what you'd want to look at first. A big factor, of course, when you look at that drop in the participation rate. I believe the figures are from the Fed and some others are saying that maybe half of that is tied to retirees. About half is tied to retirees who probably are not coming back to the market. I know my dad isn't. Then you have maybe another 1/3, maybe another quarter. I don't know what the exact figure would be. Probably tied to people on disabilities. Often that is the case that they do not come back to the market. Not always, but very frequently they do not come back to the market. I don't know if the labor participation rate, again, the other half or the other quarter would be those people who left the job market to go back to school. Now when they do come back to school, that will have a downward impact when they do leave school and do come back to the market, that will have some downward pressure on wages because that'd be more supply. Right now, it's not necessarily having the impact as you suggested in your question. I think probably what you want to look at is the impact of the unemployment rate. Who's in it and what? Long-term unemployed, you have an overall unemployment rate of 5.6%, I believe. A significant amount of that has been long-term unemployed. That's slowly coming down. I believe it's now maybe 30% of the overall composition. I think what you'd want to look at is what's happening at the short-term rate of unemployed. That number has been now, it kind of was around at a 7-year low. It seems to track wages very closely, and I'd watch that. Watch that go down. If that continues to go down further as we expect, then you could actually see a wage pickup. So I think maybe the labor participation rate, you want to look at a smaller group in that, maybe not retirees and those people who aren't coming back to the market. Look at what's happening with those people that maybe went back to school. When they come back, that could put downward pressure. But the other thing to look at is those people in the market. Look at the short-term unemployment rate for a good read in my view on what to expect from wages down the road.
So Jeffrey, this is Mark. So one of the best summaries I've read about kind of measures of labor market slack, which is really kind of the basis of the question. What is kind of relative supply or supply relative to demand for workers, and hence wages being the price of that particular market. And so Janet Yellen last year in Jackson Hole outlined lots of different measures of labor market slack that the Fed's looking at, and they have an indicator that's a composite of 19 different measures of labor market slack. And I think, as Beth Ann was saying, if you're looking at those, a lot of those measures indicate that there's still a fair amount of slack. Now, some work we did here, though, I felt was kind of an interesting experiment, which is, why don't we look at those sectors which actually have done really well, and do we actually see wages picking up? And when we were looking at that data, what you saw, especially in the oil and gas field industry that was just has been booming for the past couple of years, you actually did see wage acceleration there. So I think the private sector is expecting, the Fed is expecting, as these measures of slack begin to dissipate, and you have to look at a bunch of them simultaneously because no single measure is perfect. I mean, when Beth Ann very articulately said all the things you have to keep in mind, just looking at the LFPR, for instance, once those measures of slack do begin to dissipate, and they are uniformly beginning to dissipate, then we will start seeing wage pickups, which would be great.
Great, thank you both for that. Our next question comes from Wei Huang. His question was, what do you think about the impact of the low oil price on consumer spending? To what extent do you think the growth in consumer spending comes from the lower oil prices?
Do you want me to do it, or?
Why don't you go first?
Okay. In terms of that huge drop in oil prices, and of course that translates into much cheaper gasoline prices at the pump, I don't have the exact figure as of today, but I believe since we've seen that huge drop from around $100 in terms of West Texas oil down to under 40, I guess $45 now. Where we're at, that had to translate to, at least when I looked at gasoline prices, that was over $1 drop in the national gasoline price level, from where it was in June. Might even be lower now than more than $1, but say it's $1. The impact of $1 drop in the price of gasoline nationwide, given that the average household or the typical household buys about 1,200, according to the Department of Energy or the EIA, what you see is that households buy about 1,200 gallons of gas a year. So if that price stays that low, $1 down, that means you're getting $1,200 back in your pocketbook. A lot of that money we believe will be spent if it does stay low, if oil prices do stay low throughout the year as we expect. Much of that will likely be spent. Even if you said that maybe about half of that would be spent, that's a significant boost to GDP going forward. And I think probably that you could call it a transfer, not necessarily just from, not necessarily. I guess my point here is that you could call it a transfer, meaning that from basically oil export countries and also oil companies transferring that money from revenues to them to savings to U.S. consumers, and I do see that as a pickup for growth for 2015.
Mark, do you have anything to add there? Or should we move on to the next question?
I agree with everything that Beth Ann said, and given the fact, one way to think about this from a big picture point of view is that the U.S. is still a net importer of oil, and so when there is a price drop, it tends to benefit the United States on average.
Great, thank you. Our next question is from David Eckert. He's from Olney, Texas, and his question is, if Congress fails to act on the reauthorization of the EXIM Bank with a June 30th expiration date for everybody's reminder, what does S&P see as the drag on the trade and manufacturing components of the U.S. economy?
Well, I can only speak as an economist. I don't know. I'd have to touch base with my ratings, my S&P rating counterparts on this. But I can say in terms of the impact of, say, there is a failure of the EXIM Bank to get authorized, or for Congress to authorize the EXIM Bank further monies to the EXIM Bank. What you could expect to see is, well, if you don't get a loan, well, then you're probably not going to be doing business, and that could certainly slow down growth, certainly slow down some manufacturing activity, trade activity going forward. I don't have the numbers to that, but I would suspect that actually would slow growth in that region, in that area, and slow down growth overall.
Yeah,
Great,
Mark.
thank you.
Mark. We just have lots of companies who, I work at the Commerce Department, so we talk to companies all the time. There are just so many companies who talk to us about the problems they have in terms of getting financing for trade deals, and the EXIM Bank does fill an important role, and a lot of other countries do this as well. So again, we like to be on a level playing field with everybody else.
Great, thanks. Our next question comes from Sharon Simonson. She's with SiliconValleyWorld.com. And her question is, can you talk about the relationships between the high-tech sector and national growth? And can you discuss the multiplier effect of high-tech jobs relative to other jobs? Some argue it is much greater than the multiplier effect from other job creation. Also, can you talk about the effects of keeping the cap on H-1B visas and whether it actually reduces the total U.S. job creation? There was a lot there, so maybe we'll start with, can you talk about the relationship between the high-tech sector and national growth and the multiplier effect of high-tech jobs relative to other jobs?
Beth Ann, is it okay if I go ahead and
start? Yes, please do, and then I can chime in.
Yeah. So when we think about Silicon Valley and the high-tech sector, the biggest effect that has on the U.S. economy, and this has been true for quite some time, is the benefit that our society receives from the value of the cool innovations that come out of Silicon Valley. And when we're thinking about the big picture GDP, we're talking about this contributes significant GDP growth through higher productivity. if you think about how you do your jobs today relative to how you did your jobs 20 years ago, it's actually quite different because of all the great communications technology, the great software, the great hardware, the great internet infrastructure that allows our society to be more efficient, makes our companies more competitive, makes our companies more productive, makes our companies more profitable. So when we're thinking about Silicon Valley and the effect on the economy, most people are really focused on is like, how are these innovations going to make our country more efficient, more productive, more competitive? When it comes to the jobs, when we've looked at data on jobs in the high-tech sector, a job in the high-tech sector is quite different than jobs in other sectors because they pay a lot more. So if you're talking about your typical high-tech job compared to your average job in the economy, yes, the multiplier is going to be bigger, in part because the wages are just so much higher. So Beth Ann?
In terms of what Mark had said, I don't have much more to add. I mean, I pretty much agree with that. I could answer the second question though, if you want to bring that up again, Liz.
Yeah, that would be great. So that question was, can you talk about the effects of keeping the cap on H-1B visas and whether or not it reduces total U.S. job creation? Thank you.
Sure, the cap on H-1B visas. We did a piece, and does that reduce overall job creation or total job creation? I can give you. I can kind of give you something. We had done a study on immigration reform, and particularly employment-based immigration reform, and what we found is, kind of in a line to what you were saying, is that if we actually what we find is that high-skilled workers, not necessarily just immigrant workers, but if we did increase, you could say, or put the cap, raise the cap of H-1B visas, what you'd end up seeing is that a lot of this activity, particularly from these high-skilled workers, spend and invest, and as Mark had talked about, certainly innovate. That ends up actually supporting business and growing the economy. Indeed, if we saw an increase in terms of employment-based immigration reform, similar to the Senate bill that I guess of last year, that we would actually see, we would add about over the next 10 years, about 32 basis points a year to growth on average. Part of this indeed would certainly increase jobs overall, because what you also find out is that a lot of this kind of high-skilled activity among, say particularly from the immigrant high-skilled workers, help create jobs in terms of the innovation and productivity. Some of these studies have been shown, have been done on this, showing that this activity, this kind of knockdown effect in terms of the innovation and the new jobs that are created, I see this as a plus. So putting a cap on the H-1B visas, in terms of our analysis, that would suggest that it would, I don't know if it's the word to say that would reduce jobs, it would keep jobs as they are, but if we raise the cap, you might actually see more jobs created.
Okay, great. Thank you both. We have time for one more question, which is an email question. I don't see anyone else left in the queue, so we'll finish up with this question, which is kind of a summary of everything we've talked about here so far. While the U.S. GDP is good, we operate in a global economy. What do these numbers that we've talked about mean compared to the rest of the world?
Beth Ann, you want to go first? No.
Sure. I can take that. What we've been saying, kind of our overall forecast on the global economy, the U.S. We see this recovery that we've been experiencing, particularly over in the last, this recovery over the last 5 or 6 years has been somewhat of basically a two-tiered recovery. Surprisingly, we went through the most synchronized world recession in history, and now we're looking at a two-tiered recovery, meaning that the U.S. recovery has strengthened certainly over the last several quarters, and it seems to be building momentum as we go into enter 2015. While the counterpart, look at the eurozone. The eurozone has weakened further and is threatening or flirting with a third recession. Japan is in recession, and some emerging markets have slowed. So you're seeing kind of a parting of ways in terms of recoveries as we enter 2015. That also explains why monetary policy decisions have parted ways as well. We're looking at the Federal Reserve. Whether you agree with my forecast that they will likely raise rates for the first time in almost 10 years in June of 2015, look at what's happening with the ECB and also with Japan in terms of actually monetary policy kicking into gear in terms of moving into quantitative easing. So I'd say that these seem to kind of play out as we move along, and that's what we're expecting. In terms of the expectations for growth in emerging markets, we still expect to see China continue to show single-digit gains. I think we're looking at around 7%, possibly 6%. I don't have the exact numbers in front of me. Eurozone, we do think that they will avert recession, but again, it's going to be very, very, very low growth for the Eurozone. While as U.S., we're expecting 2015 to be around 3.3% growth for 2015 and around a little lower than that for the next year.
So, this is Mark. Let me just make two additional points to the good summary that Beth Ann just provided. One of those points is if you look at the most recent Davos conference, I mean, there the theme was the United States being kind of this economic beacon for the world in 2015, perhaps even into 2016. And the question there is, how much could the U.S. support the rest of the growth in the rest of the world? Then you can also look at exchange rates, and there are various reasons why exchange rates move around. But I think the world is voting that they have a lot of faith in the United States relative to other countries. That's one of the reasons why the U.S. dollar has appreciated so much, say, against the euro. Beth Ann talked about just the economic difficulties they have there. And as also Beth Ann said, you do have a deceleration in growth elsewhere, especially in Asia. So I think looking ahead, people have been, professional forecasters have been, somewhat pleasantly surprised what's happening in the U.S. and the forecast for the U.S. Beth Ann talked about her forecast, I believe, for 3.3% growth in the U.S. in 2015, whereas the forecasts for other countries have on net been downgraded. That's consistent with the latest IMF publications.
Parting of the ways.
Great. Thank you both. Anything to add to that? I think that's all the time we have for today. Again, thank you to Undersecretary Mark Domes and economist Beth Ann Bovino for taking the time to join Business Forward's conference call with our Business Leader Network on GDP. You will all get a follow-up email from us later today. So thanks for joining us, and thanks to Mark and Beth Ann.
Okay, thank you, everybody.
Yeah, thanks
Have a good weekend. Go Seahawks.
Bye, everyone.